Why does seeing an arbitrary number jump by $100,000 on a real estate application suddenly make you feel like a wealthy millionaire? That sudden psychological surge of paper wealth frequently triggers a dangerous desire to immediately fund premium luxury kitchen remodels or expensive family vacations. It feels completely harmless because our brains operate under the comforting, deceptive assumption that our structural property asset is generously paying for everything. Why does witnessing a higher appraisal valuation on a screen actively drive intelligent homeowners to execute choices that systematically jeopardize their financial baseline? The answer relies entirely on a hidden psychological exploitation engine, engineered to convert your permanent brick-and-mortar stability into highly volatile corporate profit. Today, we expose the underlying behavioral mechanics of this systemic trap, unlocking the secret reasons your home equity might actually empty your wallet. Behavioral scientists observe that a modest 10% appreciation in unrealized real estate valuation predictably inflates non-housing retail consumption by approximately 4%. This aggressive spending occurs despite the absolute reality that your actual liquid disposable paycheck income has remained entirely stagnant during that identical time frame. Modern commercial banking institutions masterfully exploit this exact cognitive liquidity bias to frame your residential property as a convenient personal ATM. When neighborhood valuations climb, our risk perception plummets, causing us to view high-interest variable debt as a well-deserved reward for good homeowner behavior. Transitioning solid fixed equity into a floating interest framework instantly alters your entire household balance sheet, inviting massive structural vulnerabilities. This simple psychological miscalculation exposes your family directly to sudden, unpredictable macroeconomic shifts orchestrated by aggressive central bank monetary policy adjustments. Consumers eagerly sign up for a home equity line of credit, completely ignoring how variable parameters allow lenders to adjust interest rates. They falsely believe they are utilizing cheap money, neglecting the systemic truth that variable debt behaves like a slow-moving, wealth-draining anchor. Your primary home is fundamentally an illiquid consumption asset, yet financial systems continuously try to synthesize it into a hyperliquid borrowing mechanism. This intentional synthesis serves to erode your long-term generational wealth while generating consistent, predictable cash flow interest for major banking corporations. By utilizing property asset leverage for immediate non-essential lifestyle inflation, you essentially transform a permanent safety net into a dangerous liability. The temporary pleasure of a modern kitchen or premium vacation quickly fades, leaving behind a persistent, growing financial obligation tied directly to your roof. As interest rates fluctuate upward, the compounding weight of that seemingly innocent credit line begins to actively cannibalize your remaining monthly discretionary cash. You are left trapped in a cycle where you own an incredibly expensive asset on paper, but remain functionally broke every single month. This specific state of being asset-rich, yet cash-poor, is precisely the deliberate structural outcome that the modern debt consolidation system intends to maximize. Your psychological perception of wealth is systematically used against you, turning paper equity gains into actual out-of-pocket interest expenses paid to institutional lenders. Understanding this exact cognitive distortion is the critical first step required to actively defend your hard-earned wealth from these asymmetric capitalistic forces. To survive this complex landscape, consumers must upgrade their fundamental financial literacy baseline and completely reevaluate their current personal finance strategy. Upgrade your financial literacy baseline before asymmetric market forces optimize against your lack of preparation. Subscribe to Economecha now to master the hidden behavioral rules that protect your generational wealth from systemic erosion. Let us perform a rigorous side-by-side performance contrast over a 5-year timeline to uncover how these mechanisms actively reshape family balance sheets. Family A consciously chooses to lock their $100,000 property asset safely away, completely shielding it from short-term temptation or market volatility. In stark contrast, Family B decides to extract that identical $100,000 via a variable rate credit line to fund non-essential luxury consumption. Their initial interest rate sits at a seemingly manageable 5%, a deceptive baseline that makes the immediate monthly obligations look entirely harmless. However, central bank monetary policy adjustments rapidly intervene, triggering a sequence of aggressive macroeconomic changes that disrupt the entire financial ecosystem. Within years, that initial baseline aggressively climbs from 5% to a punishing 9.5%, instantly rewriting the rules of their household debt obligations. The embedded infographic layout visually exposes the massive divergence, mapping out exact balance sheet figures that contrast structural stability against compounding systemic erosion. Family A remains entirely unbothered by these fluctuating macroeconomic metrics, comfortably retaining the complete integrity of their long-term generational wealth. Meanwhile, Family B discovers that their monthly interest payments have effectively doubled, draining actual liquid cash directly out of their paycheck. They are suddenly forced to confront the leverage paradox, realizing they are drowning in high-interest debt while living inside a highly valuable property. The premium kitchen remodel and the luxury family vacation have long passed, yet the compounding debt framework remains permanently anchored to their address. Every single dollar that should have been routed toward retirement or emergency funds is now legally hijacked by commercial banking algorithms. This case study cleanly demonstrates that paper real estate appreciation is entirely meaningless unless your immediate cash flow remains structurally protected. Treating an illiquid fixed asset as a revolving funding source is mathematically engineered to transfer wealth from your household to the institution. If you continue to navigate the modern real estate market using outdated behavioral assumptions, your balance sheet will inevitably face optimization. To entirely neutralize this systemic vulnerability, you must deploy a specific scientific environment control skill known as the fixed asset quarantine strategy. Homeowners must learn to completely decouple paper property appraisal valuations from their operational day-to-day net worth and asset tracking metrics. This requires applying a mandatory 30% psychological haircut to all automated valuation models provided by online real estate tracking portals. By artificially suppressing that inflated number in your mind, you instantly deactivate the cognitive triggers that drive irrational consumer spending habits. Your home must be treated strictly as a sanctuary of permanent physical stability, rather than a speculative high-risk variable borrowing mechanism. True household wealth is measured exclusively by your immediate liquid runway, utilizing cash and liquid assets that require zero debt leverage. Log into your financial tracking portals tomorrow morning and manually adjust your visible net worth metrics to exclude all unrealized home equity. Evaluate your actual survival capabilities based solely on what is liquid, forcing yourself to see the raw reality of your disposable capital. This deliberate environmental adjustment completely immunizes your brain against the deceptive wealth effect, ensuring your long-term survival in an unstable market. Master the hidden behavioral rules of money psychology, safeguard your family foundation, and ensure you never let paper illusions empty your real-world wallet.